Good morning, everyone. So I've been busy today. The first trade I want to go over is I did a modified synthetic long in NVDA. The chart is the 4-hour IADSS chart. It's trading between resistance and support and right on the 200 moving average. As you can see it coming in, this is on every one of my charts. We also had a minus 1.8 mean reversion reading. For me, this is close enough, good enough, because I want to start building a larger position in NVIDIA. I bought some in April during the tariff tantrums, but not enough. So for me, this is my entry. I am going to show you why I chose a modified synthetic long and which one I picked. Can you do a synthetic long on this? Of course, but you need to understand the risk. When you sell a put and buy a call, you have the same exact risk profile as owning stock. I am not personally convinced that NVIDIA has found its bottom yet. I'm not convinced the overall market has even found its bottom. Why? The other day I discussed with you the QQQ trading range. Let me show you the 12-hour IADSS QQQ. We are sitting on support at 585. We're at 600 right now. Double top resistance at 640. Here's the daily 200 moving average. If this doesn't hold, NVIDIA probably won't hold. So for me, I want to have a parachute that I can use to drop my cost basis. That's what this trade will do for me and why I chose it. So what I did was I looked for the call that was 50-50 intrinsic extrinsic, and I started to look at the at-the-money put, which I will sell, and I will buy a put further out of the money. I am selling the 180-150 put spread. I'm not bringing in huge credit. I'm only bringing in a $15 credit to offset my call, which is going to be roughly $81, but I have a plan for this trade. If it just goes straight up, I'm great. This trade will do beautifully. It's because it's a 50-50 intrinsic extrinsic. If this market comes down and NVIDIA takes a hit, I will adjust my long put, the long side of this put spread, lower to bring my cost basis on my call lower. So it's a two-pronged approach. That's why I'm utilizing this right now, because I'm not convinced we are at the market bottom. I will deploy synthetic longs when we are at an absolute bottom. I'm not sure of that yet. So this is my in-between, my intermediate strategy when I want to start to dip my toe in, but I don't want to put my whole foot in. So this is what my trade will look like. I will be doing a 3-leg trade. I have it set up as a custom setting. I will buy the 140 call. I will be selling the 180 put, and I will be buying the 150 put. My combined debit is 66. Let me show it to you real quickly on the whiteboard because I know that helps all of you visualize. So we have NVIDIA, calls puts. Stock price is 180. I sold the 180 put. I went out as far as I could in time, and I bought the 150 put. My combined credit was $15. That matches my criteria. Whatever the width of my spread is here, which is 30, I want to receive at least a 50% credit for selling it. Then I took that premium and I went and I bought the 140 call at roughly $81 debit. So what is my break even? It is my combined debit, which is 66 on top of the 140 call. So 140 plus 66. So my break even is going to be 206 on this trade. Right now, the stock is at 180. The all-time high on it is roughly 210. So when we break our all-time high, this will be there to pick up point for point, which I love. Deep in the money option. The delta of the option that I chose, in case any of you ask, is 81. And of course, the delta, I get that positive delta from my put spread as well. So I will make almost point for point on the upside. And should the market move against me, I will have a strategy in place, which is I will take my 140 call and roll it down, and I will fund it by rolling my 150 put down, meaning I might choose to sell my 150 put and buy the 140 put. and I might bring in a $6 credit in doing this. I will then take that credit to take my 140 call down to hopefully 120 or 110. This is phase 2. We are not there yet. If I do it, I will show it to you and teach you and use it as an educational experience. But for right now, I just want you to see what I did. I sold a put spread, which was the December 2028 180, 150 put spread. And I took that premium to buy an in the money call, which was the December 2028 140 call. I did this for a combined debit of $66. So my outlay was $6,600 per contract, and my margin requirement is the $30 spread. Why 30? I sold a 180 put and I put a floor in at 150. What does that floor do? Stops the bleeding right now for that short put. This is the variable. These are the pieces that I will move. Market moves against me. I will roll this down, my put down, and I will use increasing my margin. Remember, if I sell the 150 put, roll to the 140, I increase my margin. I take it to offset the cost of rolling my call down. This was trade 1 I did today, and I'll share some more in a little while. Thanks for watching.